Imagine this. You've got a completely bulletproof trading plan. I mean, the math is totally flawless.
So, of course, on paper it always is.
Right. You've charted the levels, you've analyzed the volume, you know exactly where your edge is, so you sit down, you click buy, and then in literally a fraction of a second, your calm, analytical brain just vanishes.
Just completely gone.
Completely replaced by this, like, panic stranger who is suddenly willing to break every single rule you literally just wrote down.
We've all been there. It's terrifying.
It is, and today we are exploring exactly why that happens. So, welcome to the deep dive. We're jumping straight into episode 4 in the series of The First Variable.
Which is titled The Mid-Trade Override When Emotion Sounds Like Analysis.
Exactly. And this is all based on the framework developed by Stefan. The mission today is to really tear down the mechanics of self-sabotage under pressure.
Yeah, we're going to look at the exact biological and, well, psychological shifts that happen the very moment real money's on the line.
And how our survival instincts actually disguise themselves as advanced market analysis. Plus, you know, how you can actually build a firewall between your strategy and your own worst impulses.
That firewall is so critical.
It really is. Let's get right into the foundational problem here. The person who drafts the plan on a Sunday afternoon with their coffee and their quiet room is fundamentally not the same person who is trying to manage the live position on a Tuesday morning.
Right. And that gap, that specific gap between the planner and the executor, that is where almost every catastrophic financial decision is born.
It's like two different people living in the same body.
It literally is, biologically speaking. Because if we want to understand why you sabotage yourself, we have to look at the underlying neurochemistry of a state change.
Okay, state change. Walk us through that.
So when you are sitting in that quiet room on a Sunday, the market is closed. There is no active threat to your capital.
Right, you're just looking at historical data.
Exactly. Your prefrontal cortex, which is the part of your brain responsible for executive function, logic, probability calculation, all that long-term planning stuff, it is fully in charge.
So you're basically an emotionless genius on Sunday.
Pretty much. I mean, you are capable of looking at a chart and calmly saying, well, if price breaches the support level, my thesis is invalidated and I will just accept a 1% loss.
Sounds so easy when you say it like that.
Because you're making the decision in a state of complete emotional equilibrium. But, and this is the kicker, the absolute second that order fills on Tuesday morning, your biological reality physically shifts.
Because you're suddenly exposed.
You are exposed to uncertainty. The outcome is now personally relevant.
And the brain processes that financial exposure the exact same way it processes, like a literal physical threat, right?
It genuinely doesn't know the difference. The moment your capital and your ego are on the line, the amygdala fires up.
The lizard brain.
Exactly, the lizard brain. Your sympathetic nervous system engages. You get cortisol and adrenaline entering the bloodstream.
Your heart rate probably spikes. Palms get sweaty.
Oh, absolutely. And the defining characteristic of this state is a drastic, severe narrowing of attention.
Tunnel vision.
Yes, tunnel vision. We talk about it in high-stress scenarios like physical combat, but it happens on the charts just as violently.
That makes so much sense because when you're in that quiet room, you can see the entire macro structure, right? The weekly trends, the broader context.
But under live fire, when the position goes against you by just 10 ticks.
Your entire universe shrinks down to the 1-minute candle.
Right. Every micro movement of price feels existentially urgent, like you have to do something right now.
But that urgency is entirely manufactured by the state change. I mean, the market hasn't fundamentally changed its structure in those 10 seconds.
Not at all.
But your internal landscape is screaming at you, which completely reframes what a trading plan actually is, doesn't it?
It changes everything about how we view preparation.
Because so many people write down their levels and their parameters, and they treat it like they are, I don't know, casting a magic spell. They think a plan is a prediction.
Like, if I execute this perfectly, the market will respect my analysis.
Exactly. But the market have absolutely zero obligation to respect your perfectly color-coded spreadsheet.
The market doesn't even know you exist. It certainly doesn't care where you drew your little Fibonacci retracement.
Right. A plan is not a prophecy.
No, a plan is a strict pre-commitment to how you are going to behave when the market does whatever it wants to do.
It's an instruction manual.
An instruction manual written by your logical prefrontal cortex, specifically designed to be read by your panicked amygdala.
I love that. It's honestly no different than a fire drill. Like, we don't run fire drills because we know the microwave in the break room is going to catch fire next Tuesday at exactly 2:00 p.m.
Right. You can't predict the fire.
You create the protocol so that when the alarm is screeching and the strobe lights are flashing and your adrenaline is absolutely maxed out, your legs just know exactly which stairwell to walk toward.
You don't want your brain trying to invent a brand new escape route while you are actively choking on smoke.
Exactly, because if you try to improvise in the smoke, you will almost certainly make a fatal error. Your survival instincts prioritize, immediate escape from discomfort.
Which is usually not the smartest long-term route. And this translates perfectly to leave trade execution.
But wait, a strong plan does have to account for new information, right? Like, if the primary stairwell is actively on fire, you can't just stubbornly walk into it because that was the plan.
Of course not. You need a protocol for adaptation. Stefan's work stresses this heavily. A system that lacks a protocol for changing variables is just an incomplete system.
You have to be flexible.
You do. But the incredibly dangerous flip side is that a plan that allows you to change the rules on a whim, basically whenever you feel nervous, well, that isn't a plan at all.
It's just gambling with extra steps.
Exactly. It's just gambling.
So you have to define that boundary between, like, process-based adaptation and just an emotional override. But you have to do it before the alarm goes off.
Because if you try to negotiate that boundary while the trade is live and moving against you,
Your fear is going to win that negotiation every single time.
every single time. And you know why fear always wins?
Why?
Because it doesn't show up looking like fear. This is arguably the most insidious part of the mid-trade override.
Oh, this is the sneaky vocabulary part.
Yes. Think about it. If your internal monologue just started screaming, I am terrified of taking a loss, let's break all our rules.
Yeah.
You would easily recognize that as a purely emotional impulse, right?
Yeah, you'd be like, okay, calm down, self. That's irrational.
You'd recognize the irrationality and dismiss it. But the human brain is an absolute master of cognitive dissonance. It knows that you view yourself as a logical, disciplined professional.
So it can't just throw a tantrum.
Exactly. It cannot present the desire to break the rules as an emotional collapse. It has to present it as advanced market analysis.
Right. It dresses the panic up in a very expensive suit. It uses your own education against you.
That is the exact mechanism. The emotional state adopts your technical vocabulary to justify the need for immediate psychological relief.
Give me an example of how that sounds in a live trade.
Okay, let's say you are an order flow trader. The trade is dropping. It's approaching your hard stop. You are feeling the physical symptoms of anxiety.
Sweating, staring at the screen.
Right. Your brain won't say, move the stop, I'm scared. Your brain will suddenly hyperfixate on the level 2 data and say, oh, look at that spoofing on the bid. The liquidity is clearly drying up. This is just a temporary sweep to engineer liquidity before the real move.
They're just hunting stops.
Exactly. So if we hold the stop here, we are just giving our money to the algorithm. The prudent professional thing to do is widen the stop to give the trade room to breathe.
Oh man, that sounds so convincing. Or like if you're a price action trader, this isn't a structural break. This is just a complex pullback into a discounted fair value gap we actually need to hold.
It sounds completely legitimate.
It sounds identical to the logic you use when you are actually doing good analysis.
The vocabulary is flawless. The technical rationale might even be theoretically plausible in a textbook.
But the engine running it is wrong.
Right. The underlying engine generating that thought isn't a genuine assessment of probability. The engine is your central nervous system demanding an immediate cessation of the pain of losing.
But wait, I have to push back here. What if the liquidity genuinely is drying up? What if it actually is a textbook liquidity sweep?
It happens.
Right. So you're telling me I should just sit on my hands, watch the trade reverse, and take a completely unnecessary loss just to honor a piece of paper I wrote yesterday? How on earth are you supposed to tell the difference between actual legitimate analysis and just your fear wearing a clever disguise?
That right there is the ultimate trap for the intermediate to advanced decision maker. Novices break rules out of ignorance. Veterans break rules by outsmarting themselves.
Because we have the vocabulary to lie to ourselves.
Exactly. But Stefan's framework provides a central litmus test to solve this exact dilemma.
Let's hear it.
The key is to stop evaluating the content of the rationalization, because it will always sound smart, and start interrogating the timing and the cause of the rationalization.
Okay, so we have to look at the context in which the thought appeared.
You ask yourself a very specific set of questions to strip away the technical disguise. The first one is pretty brutal.
Lay it on me.
Would this exact same piece of new information, this so-called liquidity sweep, matter to me right now if my open profit and loss were completely hidden from the screen?
Oh, wow. That cuts right through the noise.
doesn't it?
Because if you were flat, or if you were having a great day and up on the week, you probably wouldn't even notice that specific tick on the tape. You're literally only noticing it because it's actively threatening your unrealized capital.
Exactly. The second question goes even deeper into objectivity. You ask yourself, would I make this exact same mid-trade adjustment if I were standing behind a colleague, calmly observing their screen, with absolutely zero of my own money on the line?
Ah, the coworker test.
When you remove the financial exposure, you remove the amygdala's threat response. If the structural change is objectively real, you would advise your colleague to take the exact same action.
Yeah, Bob, you should widen your stop here.
But if it's just your own fear, you likely look at their chart and say, Bob, your stop is in the right place, just let the thesis play out.
Because it's so much easier to be disciplined with someone else's money. And there's a third element to this test, right? The consistency aspect.
The consistency test is basically whether you are willing to codify this new mid-trade adjustment as a permanent rule.
Meaning I have to do it every time.
Right. If you widen your stop today because you see a specific pattern of order flow, are you pre-committing to widening your stop every single time you see that exact pattern for the next 100 trades?
And usually the answer is no.
Usually it's, no, this is just a one-time exception because this specific trade feels different.
Which means it's not analysis.
It is an emotional override. Legitimate adaptation is based on observable, predefined data that fits into a repeatable framework.
Whereas an emotional override is basically a bespoke, one-off excuse manufactured specifically to relieve the discomfort of this singular moment.
Perfectly said.
Okay, so we established that the panic is lying to us. It's using our own knowledge to trick us into seeking comfort instead of executing our edge. Let's look at the actual destruction this causes.
It's massive.
Let's say you fall for the trick. You tweak the plan mid-trade. You tell yourself, oh, it's just a minor adjustment to optimize the exit. What is the actual mathematical consequence of doing that?
The immediate consequence is the total annihilation of your strategy's expected value.
Okay, let's pull the thread on expected value, because I think a lot of people conceptualize it as a static number, like my EV is 2.5, when in reality, it's a highly fragile equation. It's not just your win rate.
Not at all. Expected value, or EV, is the mathematical pulse of your entire operation.
Right.
It is the delicate relationship between how often you win, the average magnitude of those wins, how often you lose, and the average magnitude of those losses over a statistically significant sample size.
It tells you what a single execution of your strategy is worth before the outcome is even known.
Yes, but here is the critical, non-negotiable prerequisite for expected value to even exist.
Yeah.
It only belongs to a repeatable decision process.
Oh, that's huge.
Expected value does not belong to the market, and it doesn't belong to a single beautifully drawn chart setup. It belongs purely to consistency.
Just when you're constantly injecting live, improvised changes into the system.
You are systematically destroying the consistency required for the math to play out over time.
Right, because think about the anatomy of a strategy that has actually been back-tested. You know that if you take this specific entry, place the stop precisely at the recent swing low, and take profit at a fixed 2-to-1 reward ratio, you have a positive expectancy over 100 trades.
Because that system works when the parameters are rigid, the risk is bounded, the reward is standardized.
But what happens in live execution? The entry might be generated by your pristine, tested system, but suddenly the position goes slightly offside. You feel anxious.
So you tighten the stop to break even, way too early, just to feel safe.
You get stopped out for zero, and then, of course, the trade runs straight to your target without you.
So your win rate takes a massive hit because you choked out a trade that the system naturally would have kept alive.
Exactly. Then, on the next trade, it immediately shoots in your favor. You are traumatized from missing out on the last trade, so you aggressively take full profit at half your original target just to secure a win.
Which means your entry was systemic, but your exit was dictated purely by the emotional hangover of the previous hour.
And then on a third trade, you take a loss, but you refuse to accept it, so you double your position size at the lows, hoping for a bounce to get back to even.
It's chaos.
It makes me think of, like, baking a cake.
Oh, I like this. Go on.
If you have a prize-winning recipe for a soufflé, the expected value of that recipe is incredibly high provided you follow the instructions.
Right. You measure the flour to the gram, You separate the eggs perfectly. You set the oven to exactly 375 degrees.
That's your entry criteria.
Mm.
But once the souffle goes into the oven, you start watching it through the glass, you start pacing around the kitchen.
You get anxious.
Right, you think, it's not rising fast enough. So you crack the oven door open to check on it, which lets all the heat out.
Ruining the environment.
Then you panic because it's deflating, so you crank the heat up to 450. Then you think it looks a bit dry, so you literally toss a cup of water into the oven.
And when you pull out a collapsed, burnt, soggy mess, you cannot blame the prize-winning recipe.
Exactly. You didn't actually bake that recipe. You baked a chaotic, emotional improvisation.
That is a phenomenal way to visualize it.
Creative.
You bake the emotional variant of the recipe. And this is the core of Stefan's argument regarding the mathematical fallout.
Because you can't measure the emotional variant.
Right. The expected value of your emotional improvisation isn't necessarily negative right out of the gate. It's just entirely unknown. It cannot be measured. It hasn't been tested.
The risk profile shifts radically from trade to trade.
Yes, based on whether you had a good night's sleep, whether you're in a drawdown, or whether you just feel overly confident that morning.
This is the ultimate answer to the most frustrating question in quantitative finance, isn't it? Why does a strategy that produces a beautifully smooth, upward-sloping equity curve in historical backtesting completely disintegrates in live execution?
It's because the backtest assumed flawless execution of the rules. The backtest didn't factor in you having a minor panic attack at 10:30 a.m. and moving your stop.
The tested strategy and the executed strategy have become two fundamentally different systems.
The backtest traded the market. The live execution traded your emotional state.
Wow.
And the difference between long-term success and blowing up an account isn't usually found in the quality of the entry signal.
It's in the management.
It is almost entirely determined by how you manage the space between the entry and the exit when the pressure is maximized.
Okay, let's dissect exactly how that space is mismanaged, because the source material breaks this down into three primary battlegrounds where the mid-trade override does the most damage.
These are the classic traps.
These are the specific ways we dismantle our own edge in real time. We've got stops, targets, and adding risk. Let's start with the most infamous one, the stop loss.
The stop loss is the ultimate psychological battleground because it literally forces you to confront the reality of being wrong.
Which nobody likes.
No. In a healthy strategy, a stop is a purely logical line in the sand. It is the precise price level where the structural thesis of your trade is proven invalid.
Or it's the maximum percentage of your portfolio you're willing to risk on a single probabilistic event.
Exactly. It is a vital protective mechanism decided upon when your prefrontal cortex was in control. Now, moving a stop is not inherently a violation if it is a mechanical, predefined trailing mechanism built into the strategy.
Like a trailing stop based on a moving average.
Right, that's fine. The catastrophic override is the unplanned expansion of risk.
We all know the exact feeling. The price is grinding slowly toward your stop. You can see the red numbers increasing. You pull up the chart, you zoom out, and you start telling yourself a story.
It's just hunting for liquidity just below this swing low.
Yeah. If I leave my stop here, I'm going to get wicked out right before it reverses. I just need to give it a little more room to breathe. I'll move it down just a few ticks to the next support level.
And right there, in that microscopic moment of rationalization, the entire nature of the trade has completely changed.
Because you abandon the math.
When you widen a stop, simply because the thought of realizing the loss has become intolerable, you are abandoning your original risk model at the exact millisecond it was designed to protect you.
The logic that accepted a defined, manageable loss is violently overthrown by a panicked mind that is desperately prioritizing loss avoidance.
Loss aversion is such a powerful force. Behavioral economics tells us that the psychological pain of losing $100 is roughly twice as intense as the joy of making $100.
That asymmetry drives the entire override. You literally stop managing the trade based on probabilities.
You stop asking, at what precise level is this setup no longer viable? And your entire cognitive bandwidth becomes consumed by a single, desperate question.
How can I avoid closing this trade for a loss right now?
Yes, and the danger of this shift is astronomical. Because once you violate that initial limit, once you prove to yourself that the stop is negotiable, there is no stable psychological reference point left.
You move it once to give it room, it drops further.
Now you're down even more, which means taking the loss is even more painful than it was 10 minutes ago.
Well, what do?
You move it again.
It's a death spiral.
It is the anatomy of a blown account. The trade stays open not because of any structural thesis, but purely because the financial pain of realizing the loss has not yet outweighed your psychological resistance to it. You are no longer managing risk. You are being managed by your own fluctuating tolerance for pain.
And a robust trading system can survive hundreds of predefined, calculated losses. That's just the cost of doing business.
But no system on Earth can survive a handful of massive, unbounded losses whose size is determined by how long you can remain in denial.
It's so wildly irrational when we actually break it down. We are so terrified of losing money that our solution is to move our stop, which is the one action that mathematically guarantees we increase our risk of losing significantly more money.
We amplify the exact thing we're trying to avoid.
It's crazy, but okay, that's the fear of loss. What happens when the trade is actually working? Let's move to the second battleground, targets.
Targets trigger a completely different neurochemical loop, but the mathematical destruction is practically identical.
This is where we see the transition from fear of loss to the fear of giving back.
Yes, imagine the trade takes off perfectly. It blasts right through your entry, and suddenly you are staring at a massive green number on your screen. The trade is halfway to your ultimate profit target.
Best feeling in the world.
At this moment, the human brain commits a severe cognitive error. It instantly reclassifies that unrealized open profit as realized wealth. It treats it as money you already own.
The endowment effect in real time. We place a higher value on things the moment we feel ownership over them.
Exactly. Even though that profit only exists on a server somewhere, your brain has already bought a new watch with it.
Or pay the mortgage.
Right. So a brand new threat emerges. You are no longer afraid of losing your initial risk capital. Now you are terrified of seeing a winning trade turn into a losing trade.
You are terrified of having that newly owned money taken away from you.
The original profit target, which made perfect structural sense on Sunday afternoon, suddenly feels impossibly far away. It feels abstract and risky. But the green number currently flashing on your screen, that is immediate tangible relief.
So the suit-wearing panic steps in again. The market looks a bit overextended here on the 5-minute chart. The momentum is waning. It's hitting some minor resistance. The professional thing to do is secure the bag. You can't go broke taking profits.
Classic rationalization.
So you hit flatten, you cut the winner early, and honestly, it feels fantastic.
It feels incredible. You get a massive dopamine hit. The anxiety completely vanishes, replaced by the sheer relief of certainty.
You booked a win.
Right. And because you recorded a net positive financial result, your brain rarely flags this early exit as a catastrophic failure of process. It feels responsible.
But look at what you have just done to the math. Let's assume your strategy requires a 40% win rate, but to maintain a positive expected value, your average winner must be 2.5 times larger than your average loser.
The standard math for trend following.
By consistently choking your winners out at a 1-to-1 ratio just to alleviate your own anxiety, you are mathematically suffocating the system.
You are artificially capping the right tail of your distribution. The strategy needs those full target winners to pay for the inevitable string of losses.
Precisely. By prioritizing the immediate emotional comfort of a small guaranteed win, you deteriorate the long-term win-loss ratio required to keep your head above water.
It is a slow, quiet bleed. Moving stops causes sudden, violent death to an account. Cutting targets causes a slow, frustrating death by 1,000 cuts.
But both are rooted in the exact same inability to sit with uncertainty.
That's the common denominator.
The irony strikes again. We widen stops and guarantee we lose more. We cut targets and guarantee we make less. We are systematically dismantling our own edge from both sides. Which brings us to the third and perhaps most seductive battleground, adding risk.
This one is dangerous because it isn't about fear. This is about ego.
This is the domain of overconfidence bias. Now, adding to a live position can be a brilliant, highly profitable tactic if it is built into the core strategy, right?
Oh, absolutely. Scaling in, pyramiding into strength, these are legitimate ways to maximize a trend. The catastrophic override, however, is the unplanned addition of risk driven entirely by in-the-moment euphoria.
This is when a trade goes exactly according to plan right out of the gate, and suddenly you feel like you can see the matrix.
You feel like a genius.
The market is confirming your absolute brilliance. You look at the tape and think, this is a sure thing. It's so obvious. Why did I only risk 1% on this? I should be fully loaded.
Your conviction expands exponentially faster than the actual underlying evidence. You confuse a favorable random distribution with personal omniscience.
So you hit the buy button and again, you average up, Or worse, you average down into a losing position because you are certain it's going to turn around.
You throw more capital at the idea without recalculating the risk of ruin, without moving your invalidation levels,
Yeah.
without consulting the original plan.
You inject uncalibrated massive risk into a system that was never designed to handle it.
And if it works, you feel like a deity.
Uh-huh.
But if the market does what the market always does, fluctuates, pulls back, or reverses the damage, is catastrophic.
Because you have just completely distorted the risk distribution of your entire month in a single impulsive click.
Exactly. In all three scenarios, the widened stop, the amputated target, the bloated position size, the foundational error is exactly the same.
The logic that calmly accepted the realities of probability is hijacked by a decision maker who demands immediate emotional gratification.
You trade away your statistical edge in exchange for 5 minutes of psychological relief.
Okay, I have to ask the dangerous question, the one everyone listening is probably thinking about right now.
Let's hear it.
What happens when the override actually works?
This is the worst case scenario.
Let's say you commit the ultimate sin. You ignore your rules. You move your stop all the way to the basement. You double your position size because you're angry, and you just pray. And then a massive news catalyst hits, the market rips in your direction, and you don't just survive, you make a fortune. We all know someone who has done this, or we've done it ourselves. Doesn't that outcome prove that sometimes throwing the plan out the window is actually the right call?
I will say this as clearly as possible. Being rewarded for breaking your rules is the most dangerous, toxic thing that can possibly happen to a trader.
But the bottom line is green. Why should I care how I got there if the check clears?
A good outcome does absolutely not validate a bad process. You have to remember, you are operating in a statistically noisy environment.
Right.
The market is effectively a complex probability engine. A brilliant, statistically sound, perfectly executed decision can result in a loss. And a terrible, emotionally unhinged, completely irrational decision can randomly produce a massive reward.
Because it's not a perfectly efficient grading system.
The market does not distribute capital based on who is the most disciplined on that specific Tuesday. It moves based on macro liquidity forces that do not care about your personal virtue.
Right.
But the human brain is not wired to understand random distribution. The brain is wired for outcome bias.
Outcome bias. We judge the quality of our decision purely by the result it produced, ignoring the process entirely.
Exactly. Think of it like a Skinner box in psychology. If a rat presses a lever and randomly gets a massive pellet of food, it will press that lever again.
Even if it also occasionally gives them a shock.
Right. When you override your rules and get rewarded with a massive financial gain, your brain absorbs an incredible rush of dopamine and intense relief. The bad behavior is massively fundamentally reinforced at a neurological level.
You start writing a completely false narrative about your own abilities. You start thinking, I don't need rigid rules. I have a sixth sense for the market. My intuition is just superior to the backtest. I knew it was going to turn around.
And that is the death knell. A severe deviation from the plan, which should have triggered a rigorous review of your lack of discipline, suddenly becomes false empirical evidence that future deviations are totally justified.
Stefan captures this perfectly in the source material with a really profound statement. He says, failure creates pain, success creates permission.
Success creates permission. It's so true.
That is chilling, because it implies that a random win doesn't just forgive the current mistake, it literally authorizes the next 10.
And that permission can repeat for months. You might get away with moving your stops 3, 4, 5 times in a row during a forgiving, low-volatility regime.
Your ego inflates.
Your discipline slowly rots away from the inside out. But the market is cyclical.
The environment will change.
Eventually, your emotional override will encounter a trending, unforgiving market condition that does not reverse. And because you have been conditioned to believe that your rules are optional, you will freeze.
You will ride that position all the way down and blow up your entire account in a single afternoon.
A randomly successful override is infinitely more damaging to your long-term survival than an override that immediately fails and teaches you a harsh lesson about risk.
So if we have to be this incredibly strict, if outcome bias is this dangerous, is there any room at all for intuition?
That's a fair question.
Because if you look at elite professionals in high-stakes fields, master chess players, veteran fighter pilots, trauma surgeons, they rely heavily on intuition. They often look at a situation and just know something is wrong before they can even articulate why. Are we supposed to just completely ignore our gut feeling in the market?
Stiffin's framework addresses this beautifully, and it validates your point, but with a massive critical caveat. Intuition is real, but it is not magic.
What is it then?
Intuition is simply rapid, uncalibrated pattern recognition. A veteran trader's brain has absorbed tens of thousands of hours of market data. The subconscious mind can process micro shifts in order flow or structural momentum much faster than the conscious prefrontal cortex can assemble the words to describe it.
So that gut feeling of anxiety when a setup doesn't look quite right, that is actually real data.
It is real data, but the caveat is this. Intuition does not become reliable merely because it feels incredibly convincing in the moment.
Because our memory of our own intuition is incredibly flawed, right? We remember the times our gut was right, and we conveniently forget the 50 times we were sweating over nothing.
Hindsight bias takes a vague feeling of general anxiety and retroactively transforms it into what looks like precise visionary foresight. Stefan's rule for managing this is crucial. You must respect your intuition as data, but you absolutely must not automatically obey it as a rule.
Treating it as data, not a rule. How do we actually operationalize that? How do we do that on a Tuesday morning when the chart is moving?
Through aggressive, honest journaling. If you want your gut feeling to earn the authority to dictate real capital, you have to force it to prove itself over time.
Okay.
When you get that intense intuitive hit that a trade is going to fail, you don't instantly click sell. You write it down. You record exactly what the market was doing, what specific anomaly you think you noticed, what action your intuition demanded, and what the ultimate outcome of the trade was when you stayed with the original plan.
You basically have to categorize your performance into what Stefan calls clean data versus contaminated data.
Yes, that distinction is everything.
Let's define those terms, because understanding the difference seems foundational to fixing a broken strategy.
Okay, clean data is the pure output of a fully compliant execution. Whether the trade resulted in a win or a loss is completely irrelevant.
So long as you follow the rules.
If you entered, according to the rules, managed risk precisely as planned, and exited where the system dictated, that trade generates clean data. It is an accurate observation of your strategy's true expected value in the current market regime.
So contaminated data comes from any trade where you improvised, widened the stop, cut the target, or chased an entry.
You still record it.
A contaminated trade still contains incredibly valuable information, but it is no longer telling you anything about your strategy. It is telling you about the specific psychological triggers that cause you to break down. That makes total sense. If you mix your clean data and your contaminated data together in your weekly performance review, you are looking at a meaningless mathematical sludge.
You'll be totally lost. You will spend months constantly tweaking your indicators and changing your entry criteria, desperately trying to fix a strategy that is actually perfectly fine.
Completely blind to the fact that your own inconsistent emotional execution is the only thing destroying the edge.
Right. You have to study your intuition outside the pressure cooker of a live position before you ever promote it to a formal, actionable rule in your playbook.
Okay, this brings us to the absolute crux of the issue. We understand the biological state change. We recognize the sneaky, technical vocabulary our fear uses to manipulate us.
We see the mathematical devastation it causes.
And we know we can't trust random success or untested intuition. But, and this is but all of that logic exists in the quiet room.
Right, on Sunday.
How do we actually survive the visceral, intense moment when the impulse to override hits us mid-trade? How do we bridge the gap between knowing better and doing better?
We have to redefine the goal entirely. The goal is not to become a stoic robot. The goal isn't to meditate until you never feel fear, greed, or doubt again.
Because that's biologically impossible when risking capital.
The emotions are allowed to exist.
Right.
The goal is simply to build a mechanical barrier that prevents the emotion from automatically becoming an unthinking instruction.
The true test of an elite decision maker happens in the microscopic gap between feeling the intense impulse to act and the physical action of clicking the mouse.
You have to force that gap open. You have to interrupt the circuit.
And Stefan outlines a highly practical mechanical defense mechanism for this called the pause protocol.
It's so simple, yet so effective.
When the impulse violently hits you to change the parameters of a live trade, assuming it's not a predefined technical emergency like your data feed disconnecting you, you do not act immediately. You force a hard stop.
You take your hands off the keyboard, literally, and you force yourself to physically write down the answers to 4 specific questions.
The physical act of writing is key here, isn't it? Because it forces the brain to shift gears. You can't write a coherent sentence using only your panicked amygdala.
Writing re-engages the prefrontal cortex. It forces this swirling, overwhelming internal cloud of anxiety to condense into a concrete, observable, and usually very unconvincing statement on a piece of paper.
Okay, walk us through the 4 questions of the pause protocol.
Question 1. What has objectively changed in the market data? Not what feels different, not what you are afraid might happen, but what specific, objective, chartable data has shifted since you entered the trade.
Forces you to look at the facts. Question 2.
What specific action am I considering taking based on this change? Am I moving a stop, closing the position, doubling down? Define the action precisely.
And question 3.
Which of my pre-existing written rules explicitly permits this specific action under these specific conditions?
That's where the rationalization usually falls apart. You realize there's literally no rule.
But the fourth question is the real kill shot to the override. We touched on it earlier. Would I make this exact same decision right now if my current profit and loss were completely hidden from view and this wasn't my money?
It is a phenomenal protocol because when you force yourself through that filter, the sophisticated panic loses its suit.
It's just standing there naked.
The thought, oh, the market structure feels heavy and liquidity is drying up, suddenly gets written down as, the price moved against me by 3 ticks, no actual invalidation level has been breached, I have no rule for this, and I'm just terrified of taking a normal loss.
It strips away the illusion of analysis. It forces you to confront the reality of your own behavior. And this ties directly into the deepest philosophy of Stefan's work, a concept he calls cause before effect.
Let's unpack that. Cause before effect.
The move stop, the early exit, the chased entry, the double position size, those are not the problem. Those are just the visible effects.
It's a symptom.
The underlying cause is always the decision maker's fundamental inability to tolerate the discomfort of uncertainty. If you don't address the cause, trying to fix the effect is like playing whack-a-mole.
Let's say you just try to force yourself to stop moving your stops using sheer willpower. You tape a note to your monitor that says never move your stop, but you haven't actually addressed your underlying terror of losing money. What happens?
The emotion just finds a new outlet. Water always finds a crack in the foundation.
Right.
You might successfully hold your stop, but because the internal pressure is still unbearable, you'll suddenly start cutting all your winning trades early just to relieve the tension.
Or you'll start hesitating and missing perfect entries entirely out of fear.
The physical behavior changes, but the psychological cause survives and adapts. The only way to truly elevate your execution is to make the root cause visible through protocols like the written pause, acknowledge the discomfort of uncertainty, and consciously choose to endure it in the service of your statistical edge.
Cause before effect. It is such a profound framework, and honestly, it applies to so much more than just trading financial markets. It's a blueprint for how we handle any high-pressure environment in life where uncertainty and ego collide.
It really is.
Which makes this the perfect moment to consolidate everything we've torn apart today. As we wrap up this deep dive, let's lock this knowledge in using Stefan's first variable review framework.
It's a brilliant, concise way to distill the core concepts we've explored.
I'll lay out the framework, and let's define each piece based on today's session. First, the effect. What was the visible behavior, decision, or outcome that we examined today?
We examined the mid-trade override. Specifically, we looked at the destructive behaviors of widening stops to avoid realizing a loss, cutting targets early to secure the emotional comfort of an unrealized gain, and the unplanned scaling of positions driven by uncalibrated confidence.
Next, the cause. What underlying mechanism contributed to that effect?
A profound biological and psychological state change, triggered by the sudden reality of financial and ego exposure. It is the primal need for immediate emotional relief, which bypasses the prefrontal cortex and adopts highly analytical, technical language to justify abandoning the original logical plan.
Third, the mirror. What does this specific behavior reveal about the decision maker?
It reveals a fundamental struggle to sit with and tolerate uncertainty. It reflects a tendency to prioritize immediate psychological comfort in the present moment over the discipline required to maintain a repeatable statistical edge for the long term.
Fourth, the responsibility. What remains entirely within the listener's direct influence?
2 critical things. First, the ability to meticulously track and separate compliant, clean data from emotionally contaminated data in their journaling. And second, the absolute responsibility to build and protect the space between feeling an emotional impulse and executing a physical action.
And finally, the practice. What specific response can our listeners train to combat this?
The four-step written pause protocol. Training yourself to force a physical pause, re-engage the logical brain by writing down the objective market changes and consulting predefined rules before ever allowing yourself to modify a live position.
That is a masterclass in behavioral self-regulation. Now, to make this intensely personal and actionable, we have two specific journal questions tailored directly from today's material. We want you, the listener, to sit with these.
Don't just answer them in your head. Actually write them out.
This isn't about factual recall of the deep dive. It's about looking in the mirror. Question number 1. When I look back at my most regrettable, destructive deviations from a plan, what specific analytical or logical excuse did my fear or greed use to justify breaking the rule?
That is the essential work.
Mhm.
You have to learn the specific vocabulary of your own panic.
And question number 2. In what specific area of my life or work do I most frequently confuse a change in my own internal emotional state with a change in the objective facts of the situation?
That question really expands the scope. It forces you to see how this dynamic plays out far beyond the trading screens.
It really does. It's been an incredible, intensive deep dive today. We've gone from the biological realities of the fire drill to the sneaky, sophisticated vocabulary of our fears, all the way to the rigorous mathematical necessity of the pause protocol.
It's been a great conversation.
But as we close the book on this session, I want to leave you with one final, unresolved thought. Something for you to let simmer in your mind as you approach your screens tomorrow.
Think deeply about this as you prepare your next plan, your next trade, or your next high-stakes decision. If the market is completely blind to your anxiety and your original strategy was explicitly designed to ignore your emotions, who exactly is your mid-trade override actually for?
We will leave it right there for today. Keep observing, keep questioning, and we will catch you on the next deep dive.